Kerry Boulton is Australia's most respected exit strategy advisor and CEO of the Exit Strategy Group. Welcome to this week's segment.
Private equity firms are organisations, particularly in relation to using superannuation funds, and they're firms that have built up and act as investment managers looking for higher returns than they might otherwise get just in putting money into cash deposits and those sort of investment vehicles. So these are firms that work pretty hard to get the funds under management, and then they focus on serving their owners, of course. And so they're looking for businesses that they can invest in, usually revenues somewhere between $8 million to about $88 million. That's almost what you'd call a middle market, although that's not a term that we hear very often here in Australia. Their approach is really one of creating long-term value in the business with which they partner, and they can usually have some pretty good leverage and contacts to be able to grow the business substantially. And they have actually been around for years, but they grew out of the venture capital days back in the 1980s. So, but today they are more prevalent simply because of the great sums of money that are around in superannuation funds. And the way they work is that they will usually buy into your business in one way, shape or form, and then look for what they call an exit within 3 to 5 years. So they want a pretty quick turnaround with the business. They're in there to grow it, not for the great long term, but in order to get a return on their investment in a pretty short time frame. Superannuation funds have billions and billions of dollars. It's not that the superannuation funds themselves don't actually go out and make investments in businesses. They look for other funds managers who will do that for them. And of course, being responsible investors of that money, they will just take a percentage of the funds that they have available to put into these types of investments through private equity firms. And the large insurance companies also do the same sort of thing through private equity firms, and also high net worth investors, high net worth individuals will do the same thing. And of course, like any investment, there must be an attractive return on the funds in line with the level of risk that they take. And they're really looking to make multiple acquisitions. They don't just, work with one and see that business on. They make multiple acquisitions based on a set of criteria that they will have agreed with their investors. And the diversification in the portfolio is really important in order to reduce the risk to the investors. So not all of the companies that private equity firms buy are going to do well, but the few that outperform will in fact improve the investors' overall return. And just as a guide, our PE firms investors are really looking for a minimum of around 25% return. That's a huge return in today's environment especially. And they require that as a minimum in terms of your business growth. So alignment between the two parties is obviously crucial, and they'll look to help you build the business and to grow it and to increase its value in the market. One of the other important factors with PE funds is that they actually have a finite lifetime, and that can range from as short as 2 years and could be as long as 10 years, but that's a really important consideration when you're thinking about your own time frame for exit. So at the beginning of a fund's life, the private equity firm executes a series of acquisitions, and they put in their expertise to grow it, and they then will sell when the business reaches the target or when the fund is due to end. So as an example, a 10-year fund, the first 5 years are focused on acquisitions and improving each of the company's performance. And then the remaining 5 years is primarily divesting the firms. Other PE firms will look for a quick entry and exit, or within a 2 to 3 year time frame. The sale proceeds are then shared between any of the company shareholders and the PE fund. And once the fund itself has divested all of the companies, the remaining returns are split between the private equity fund's investors and the fund managers themselves.
If you don't have a copy of Kerry's new book, The Uncensored Truth About Exit Strategies, please visit freeexitstrategybook.com.au.